Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
Welcome back to Modern Investing Techniques, episode FRT7. Today is May 19th, 2026. I'm Patrick, broadcasting from Vancouver. Today's markets have some interesting setups. Let's break them down. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Oil shocks and today's StatCan inflation print could lift input costs for consumer names, giving TFSA holders a narrow window to rotate into names with pricing power before margins compress further. Markets opened mixed this morning with the S&P 500 at 7,403, down 0.1%. The NASDAQ Composite sits at 26,091, down 0.5%, while the TSX Composite is at 33,833, down 1.3%. Oil volatility tied to Iran developments and the upcoming April CPI release are keeping sentiment cautious across consumer sectors. Benchmark comparison data for full year-to-date portfolio alpha versus the NASDAQ is unavailable in today's feed, so we will track individual trade alpha against the index instead. With those macro pressures in mind, let's look at how we're positioning the practice portfolio this week. When oil prices surge, the first order effect is higher input costs for retailers and manufacturers. The second order effect is which companies can actually pass those costs through without losing volume. The practical approach is to screen for firms with demonstrated pricing power, measured by gross margin stability over the prior 2 quarters and low customer concentration. Run the screen in your brokerage fundamental scanner using the filters gross margin variance less than 150 basis points over 4 quarters, and revenue from top customer less than 15%. This setup has historically worked best in the first 90 days after a sustained oil spike above $80 when energy costs are still rising, but consumer staples and select discretionary names have not yet been fully repriced. The risk is a rapid demand destruction scenario that compresses volumes faster than prices can adjust. Before we review how yesterday's trade played out, here's the exact lesson we're applying today. Disclaimer. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Our weekly hold this week is Home Depot, ticker HD, on the North NYSE. The catalyst is a first quarter earnings beat paired with unchanged full-year outlook, removing near-term guidance risk for a high beta consumer name. Technical setup shows price action above the 50-day moving average on the daily chart, with volume expected to clear the 20-day average on follow-through. Risk assessment sets a stop loss 6% below entry to cap simulated loss at roughly $60 on a $1,000 position if macro rotation accelerates. The target is 3% to 6% over the 5-day hold window if consumer discretionary rotation continues. Confidence level is medium because earnings delivery and guidance stability are aligned, yet broader oil-driven cost pressure introduces one uncertainty factor. This setup demonstrates how to convert an earnings beat into a rules-based weekly hold by anchoring the entry to post-print volume confirmation and a predefined stop. Listeners learn to treat the first 48 hours after an earnings release as a confirmation window rather than an automatic buy signal. Before we review how yesterday's trade played out, here is the exact lesson we are applying today. Last weekly hold was ACM on an infrastructure consulting contract win, providing multi-year revenue visibility. Entry came at $80.09 at Monday open, and exit was $71 at Friday close. The result was a simulated loss of 11.35% or $113.50 on a $1,000 position. The trade fell 11.35%, while the NASDAQ rose approximately 0.8% over the same window, producing negative 12.15% alpha. The multi-year contract visibility proved insufficient once broader market rotation favored higher beta AI and data center names. Rule: always require volume confirmation above the 20-day average before entering momentum trades on earnings beats. That volume lesson connects directly to the broader strategy we use when oil prices spike. Domain Money aggregates banking, investing, and goal-based planning into a single dashboard that automatically surfaces tax-efficient account recommendations for TFSA and RRSP users. The edge comes from its real-time tax alpha meter that shows the projected after-tax difference between placing a new contribution in a TFSA versus an RRSP based on your current marginal rate and expected retirement bracket. Intermediate Canadian investors who want to run quick side-by-side scenarios without exporting data to a spreadsheet should start with the free tier. The $230 million raise by Armada at a $2 billion valuation, with BlackRock participation and a new Arizona factory partnership with Johnson Controls, gives investors a listed proxy for modular data center capacity growth. Use the company's investor page to track factory permitting updates as a leading indicator for hyperscale CapEx cycles. While we are thinking about who can handle higher costs, let's zoom out to a bigger structural question. Imagine you bought a broad market ETF last week when oil headlines pushed energy names higher. Your order filled at the prevailing ask, but the ETF's underlying index weights had already shifted another 0.4% toward the largest constituents by the time the trade settled. That 0.4% drift is the mechanical outcome of market cap weighting, where every new passive dollar automatically buys more of the stocks that have already risen. Over the past decade, this loop has added roughly 1.8 percentage points of annual return to the S&P 500's largest names simply from inflows. What most retail investors do not realize is that active managers still execute the marginal trade that sets closing prices. The concrete misconception to avoid is assuming if the index keeps rising, my ETF will keep working. Instead, always check the percentage of total trading volume still coming from active desks before adding fresh passive exposure after a 20% run-up in megacaps. That passive flow dynamic matters even more when we look at the specific tools and names we are watching right now. Statistics Canada CPI print lands today with analysts flagging a clear oil-driven upside surprise that could keep the Bank of Canada on hold longer than previously priced. Trim any floating rate energy ETF exposure if CPI prints above 2.8% year over year, and add a small defensive consumer staples position on the close. Iran-related uncertainty is keeping global equity markets range-bound while Korean tech names absorb the brunt of the sell-off. Add a 1% TSX listed gold producer ETF to the watch list, only if oil closes above its 10-day high for a second consecutive session. Analysts cite the largest supply shock since the 1950s as a driver for a potential multi-year price regime shift in aluminum. Place a limit order for a broad materials ETF at 3% below yesterday's close, and set a 25% trailing stop once filled. Let's quickly hit the other headlines moving today. Total simulated trades stand at 20 with a 55% win rate of 11 wins, 8 losses, and 1 break-even. Cumulative profit and loss is negative $4.66, with an average return per trade of negative 0.0%. Best trade reached plus 13.36%, while the worst reached negative 11.35%, and the current streak is 1 loss. Our AI analysis is learning from sector rotation patterns and adjusting volume confirmation thresholds accordingly. Finally, here is your action item for the weekend. Open your brokerage screener, filter for consumer discretionary names that reported earnings in the last 5 days, and sort by full year guidance unchanged. Flag the top 3 results and note their 20-day average volume. Those are your candidates for next week's watch list. We'll check those names on Monday. Thanks for listening. Before we wrap, watch for aluminum supply updates and any surprise in today's StatCan CPI release that could shift defensive rotation signals. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking